From the 8th of October, UK retail investors can finally buy Bitcoin and Ethereum ETNs on UK exchanges. Here's what's actually changed, how these products work, and the risks most people will miss. Crypto ETNs have been around since around 2015, but in January 2021, the FCA banned them for retail investors. But that's all about to change, because on the 8th of October, UK retail investors will be able to purchase these products again on regulated UK exchanges. One of the big frustrations around the timings of these bans is that in January 2021, Bitcoin was trading around 34,000. At the time of recording, it's currently sitting at 114,000. We'll come on to the pros and cons of these products and whether I think you should use them, but first let's establish what they actually are. You'll notice that this specifically mentions ETNs, exchange traded notes, rather than ETFs, which you may be more familiar with. An ETN is an unsecured debt instrument. It's a little bit like a bond. The issuer promises to pay the investor the same return as the thing it's aiming to track. Whereas with an ETF, the issuer actually holds the underlying asset. This in itself brings about a lot of counterparty risk because you're banking on the issuer continually able to pay out the performance of the underlying asset. However, the FCA have been very specific about this, and the only ETNs that would be available is ones that are actually physically backed and non-leveraged. So that means the ETN itself does have to hold some physical storage of the underlying asset, i.e. Bitcoin or Ethereum. There will still be some slight counterparty risk because you don't know how much is actually physically backed. There could still be some slight discrepancies between different providers. But you may still wonder why the FCA went down the ETN route rather than the ETF route, which has been so popular in the US. And this is largely down to European regulations, specifically UCITS regulations. These regulations only affect ETFs because they're collective investments, and they state that the fund should have some level of diversification. And clearly an ETF that just tracks one thing is not diversified. Hence, at the moment, ETFs are not allowed just on one single product. However, ETNs and ETCs, so that's exchange traded notes and exchange traded commodities, don't come under the UCITS umbrella, hence they're still allowed. Of course, this could always change in the future, but while this regulation is still there, that's why you'll see ETFs being able to be purchased in the US, but across Europe, it's limited to ETNs and ETCs. So now we know what they are, should we actually be using them when they become available? The first thing that is striking to me is the really bad timing for this in terms of where we are in the cycle. Now, no one knows when Bitcoin will top. Some people think it's already happened, some people think it will happen in a few weeks, and some people think it will go on into Q1 of 2026. But the consensus is that there will be a top. And if we look back at previous cycles, in 2013, from Bitcoin's peak, it dropped 86%. In 2017, it dropped 84%. And then in 2021, it dropped 77%. So the losses have been diminishing, and a lot has changed since the previous cycles, the popularity and growth in ETFs being one of them. But it could still fall over 50%. So even if Bitcoin was to go up from here, say another 20 or 30%, if it then drops 50, we're going to be lower than where we are today. So you've got to ask yourself, is this the last time that we see this price? For me, it's a high probability that this is not going to be the last time that we see this price. And if you believe the same, then there's no point going in now. You may as well wait 6 to 8 months, well into next year. And that's what I'll personally be doing. One of the big pros of having these funds on exchanges is that they can now be part of your wider portfolio. So you can set up automatic and regular investments into these assets. Say we get a bear market into next year, you can then dollar cost average through that bear market, accumulating at really good prices. But the biggest pro with all of this has to be the ability to hold this in an ISA or a SIP. Now, the FCA haven't specifically mentioned these tax wrappers, but I see no reason why they wouldn't be included. You can currently hold ETCs in an ISA, whether you track the price of gold, that uses an ETC, and you can hold that in an ISA or a SIP. And they also haven't specifically mentioned that crypto will be an exemption. So I see no reason why this would be any different. And because this is definitely a long-term investment, in the next 4 or 5 years, you could be sitting on a massive amount of capital gains. If that's held in within an ISA, then you don't have to worry about any of that. Likewise with a SIP, if you're regularly investing into your pension, not only do you get the tax relief, but because you can't touch it, it's also going to take all of the emotion out. So when we do see large amounts of volatility and it coming down 40, 50, 60%, you're still going to be dollar cost averaging in, buying in at those really good prices. And because you can't touch it, at the end of it, in 20, 30 years time, whenever you come to take the money out of your SIP, you could be sitting on a really nice pot. And for most people, I think the convenience of being able to use a regulated exchange that they're used to and they hold their other investments with is a massive plus. Some people will still see it as a downside because you don't have self-custody, you don't have a wallet, and you don't have the keys, which means you don't actually physically own the Bitcoin. You hold it via an intermediary. And for some people, that is a downside. They want to have the control. They want to have the physical key. that they can hold and do what they want with. But of course, that can come with its risks as well. You have to then self-custody that. You have to secure it and look after it. If you lose it, you lose your investment. And just going through some of the exchanges that aren't regulated can be a bit of a minefield in itself. And of course, there's risks involved too. Now, we don't actually know which ETNs will be available on the 8th of October. Trading 212 have simply said that they're coming to the platform on that date. And in order to invest, you have to complete a short questionnaire, which isn't too difficult. But I put together a small list of ones that potentially could be available on that date. You'll see some well-known names such as iShares, Invesco, Fidelity, and also some more crypto-specific providers. The biggest thing for me between these funds is going to be the price, the TER. You can see the Bitwise fund has a TER of 2%. Compare that to the Invesco fund sitting at 0.1%. That may not sound like that much, but over a long period of time, that can make a massive difference. Imagine a lot of these charges will come down because they have to compete. That's going to be one of the main things that differentiates them from other providers. The reputation, of course, is going to be key. So that's why the big players such as Invesco and BlackRock will do really well here because they've already got the existing reputation. But for the other providers, in order to compete, they have to bring those fees down. You will also see some discrepancies in terms of the performance of some of these funds. Some of that will be down to the TER, but a lot of it is also going to be down to how it's calculated and the methodology. All of these funds will have spreads, which means they've got a different buy and sell price. And depending on how the fund is calculated, its performance, sometimes it will use a net asset value, sometimes it will use the last price that it traded at. So you can't always compare like for like when you're looking at performance figures. So for me, I wouldn't really look at the performance figures comparing these funds. It's tracking the same thing. So generally just look at the performance of Bitcoin. So then you're looking at the quality of the provider, the reputation, the creditworthiness, and also the fee. I would also take the size of the fund into account as well. Generally, the larger the fund, the higher liquidity it's going to have, which generally means it's going to have a smaller spread. So a smaller difference between the buy price and the sell price. That's not always the case, and it can change throughout the day depending on demand and supply, but just something to be aware of. So let me know your thoughts. Is this a good idea? Is this the right time to be doing it? Has the FCA finally caught up? Let me know your thoughts down below in the comments. I hope you found that useful. Thanks for watching, and I'll catch you in the next one.